Video on Chapter 5. Chapter 5 is on FIFO and LIFO. I've included lots of good notes and a couple of sample problems inside your announcements, so I'd ask that you please use those. FIFO and LIFO are inventory evaluation methods. So before we get to that, there's really two ways that we handle inventory. We can talk about inventory in being a perpetual inventory system. That is what you see at Walmart, right? So they get something, they scan it. As soon as they scan it, it's automatically relieved from their inventory. It happens in real time. They scan it, it goes away, right? Inventory is adjusted downward. Really, that's what we can expect to see in 99% of all companies, is perpetual inventory system. Periodic, nobody really uses anymore. There might be some small mom and pop companies, bookstores exist to do that. But all that really means a periodic inventory system is you know what inventory you have as of December the 1st. They do another count on December 31st, and what they have then versus now is what their cost of goods sold is. We don't really like that. That's something which will die and go away, so I don't really want to spend a lot of time on the periodic system. So we're going to focus most of our time on perpetual, right? Perpetual is real-time inventory relieved. We know exactly what our profit is on any given shipment, right? So let's first talk about our journal entry. The journal entry that you're going to book anytime you're buying goods and you're going to resell them is going to be a debit to either cash or AR, a credit to sales. Now that's going to be at its sell price. You're also going to have a debit to cost of goods sold and a credit to inventory, and that's going to be based at our value in the goods. So when we talk about cost of goods sold is exactly that. It's our value in the goods that are sold. It's either how much I paid for them when I bought them from somebody else, or if I went through and actually made them, produced them, manufactured them, that's going to be my cost of goods sold as well. We have a debit to our cost of goods sold, and that's my value in the goods. That acts to reduce our sale price or our revenue. The difference we said before, revenue minus cost of goods sold, is going to be our gross margin. Gross margin is really the only level of profitability that we can see, because we know how much we sold the unit for. I have an invoice how much I sold it to the customer for. And on the flip side, I know how much I paid for it because, well, I either know how much I cost to manufacture, that's my labor and material and some overhead costs. And also, if I bought it in anticipation of reselling it, well, I know how much I paid because I have the invoice from the group that I bought it from. So I always know that. So remember, sales less cost of goods sold is my gross margin. If I think about my journal entry, we said we debit cost of goods sold, and we know we debit that because revenue is normally 99% of the time it's credited, except for what we saw in Chapter 4. That's month and close only, one time a month. Revenue minus cost of goods sold is our gross margin. We credit inventory because inventory is going down, right? Remember in I think it was Chapter 2, when we bought stuff, we bought goods in anticipation of reselling. It was a debit to inventory. Inventory is going up. If I pay cash, cash is going down. So inventory went up. So when I sell something, I have to credit inventory because, well, I no longer have that good, right? It's truly out of my inventory. So our entry that you're going to book every time you have a good that's sold is a debit to AR or a debit to cash, a credit to revenue, a debit to cost of goods sold, and a credit to inventory. Again and again, you're going to book that. That's what happens when you're at Walmart and they get the good and they scan it across and they hear that little beep. That's the entry that's being booked every single time. It's super, super cool, super easy. Now, what we're going to talk about now, if we're talking about inventory valuation methods. Inventory valuation methods. And the ones we're going to talk about most part are FIFO, LIFO, specific identification. I say 90% of all businesses use FIFO. FIFO is simply first in, first out. That means the goods you receive first are the goods that you're going to value, that you're going to say, when you relieve your inventory and you calculate your cost of goods sold, they're the ones which you say you sold first. And same thing as LIFO. Probably about 6% of all companies use LIFO. LIFO, last in, first out. That means the good that you bought last are the goods which you anticipate or you tell people and you calculate that you sold first, right? Last in, first out. Specific identification, That is used only by a small number of companies. I would say car manufacturers, high-end jewelers, because what that means is you have a value, a cost of that individual item. So let's think about it as a Ferrari, right? Ferrari could have special features, certain tires, paint jobs, yada yada. So they want to keep that item, that specific unit, special, different than the others. So specific identification, it's really matching the exact item that you bought with its sale. But very few number of companies actually use that. Most of these car companies, jewelers, really high-end luxury type items. Probably, just really high-end stuff, right? For the most part, though, FIFO. FIFO is the biggest one. And now, one thing I want you to keep in mind, whether you use FIFO or LIFO or specific identification, at the end of time, the value that you have, whether you calculate with FIFO, calculate with LIFO, calculate with specific identification, they're going to be exactly the same. It's only a matter of timing. And keep in mind, we mentioned before about how in accounting we like to match the timing of our revenue with our costs. So, we want to keep them lined up the best we can, as realistic as possible. But at the end of the time, assuming that nothing is different, there's no write-offs or anything weird, the amount that you calculate, the cost of goods sold you calculate under FIFO, the amount you calculate under LIFO, the amount you calculate under specific identification are going to be exactly the same. I don't want to go into any of the calculations here. I've provided some notes and some sample exercises inside the chapter, so I'd like you to kind of focus on those a little bit for me. One thing I think your chapter also mentioned about was discounts. We like purchases discounts because what a purchase discount is when the customer is giving us cash terms, which basically means if we pay our bill within a certain period of time, usually 10 or 15 days, we'll get a discount. So you'll see that traditionally written as 2/10 net 30, 2/10, comma, N 30. 210 net 30. What that means is I get a 2% discount if I pay within 10 days, or I pay the full balance in 30 days and don't get anything. We like that. We like discounts. Anytime that you don't have to pay something, life is good. Now, we love cash discounts as long as we have the cash to actually be able to pay for it within that 10 days. We should never stretch ourselves just for a small 2% discount. I mean, if we can get it, great, right? But we should never jeopardize payroll or utilities or something that we have to have just to get this, this discount. Purchase returns and allowances. Basically, what that means is we bought goods from a vendor, from somebody. We got it. We want to resell it to somebody else. Well, the goods we get are defective, right? They're either the wrong color or whatever it may be. It's, whatever it is, and we just return them. And what that does, that basically just flips your entry. You'll have a impact your purchase returns and allowance and AR. So, really that's a good guy for us, right? The entry, if we have basically a purchase return allowance, we'll just be hitting against a purchase returns allowance account. The book does a good job of explaining that part. Just keep in mind, we love to get the discounts. We love to get the purchase returns and allowances because, the point of it is us buying goods that are usable. If I cannot buy them and sell them directly on, I should return them. I shouldn't spend a single dollar of labor, material, anything printing them up unless that's my business plan doing that. But if I buy goods and some of them are defective, we need to send them right back. We shouldn't spend a single second trying to make them work because customers know, they have a gut feel. With Philips Electronics, one thing that we definitely saw was that, customers love pretty boxes. If you saw a TV in a pretty box, it's like the colors, the blue and black and all those cool colors, that gives the customer confidence it's a good quality material. For items which were touched or refurbished, according to some of the laws that we have inside the U.S., we have to call them out as refurbished. Now that's, and which is good, right? We should do that. People won't buy them, right? People don't want, or they'll buy them at a significant discount. You can go to Big Lots or places like that and buy discounted goods. They're just as good for the most part of the new stuff, but they were out of the box, right? Anything that happens, at all, it goes to Big Lots space. There's some similar type company. Or you can buy them on their website, but they're notated as refurbished goods. Anytime that you buy a good and you, at say Walmart, you return it back, assuming there's nothing wrong with it, what will happen, that goes automatically back to the manufacturer. The manufacturer will go through, identify what's the root cause of it, and correct it if it's worthwhile, right? I mean, like for TVs, they'll correct television. If you have a small MP3 player, something of that nature, and you return it, they will throw that in the trash, right? Because there's no value in it. There's no real value in trying to repair something like that, because by the time you've already factored in the freight cost to get it back, the labor to really call it plug and play it, check it, and then potentially send it back out, there is no margin and they're running for a loss. So depending on what you have, you return it back, well, they'll fix it and they'll sell it as refurbished, but the profit margin's cut dramatically. Now, one thing I did while I was at Phillips, we did an analysis on returns, and in the analysis of returns, what we found was that most people, like when some were good, I would say that from the analysis, it was 50% of the time when goods were returned, they weren't returned because of really being defective. It was returned because either the customer decided they didn't want it or some variation of that. And of course, what happens when, in that case, even when you return it and say, hey, look, there's nothing wrong with it, I just didn't want it, they still have to send it back to the manufacturer. They should not be simply boxing it back up and putting it on the shelf. It has to go all the way back. But of course, what we found is that in these cases, most people would say that, well, the good was defective. Well, why do they say it's defective even when it's not? Well, they do it because they don't want to hassle on returning stuff. That's what people do, right? It's what happens along the way. So, it just, from a purely business side, analytical side, that really cuts into a company's margin. So, I mean, you all probably see similar items as you all go into accounting or business. People return items not because they are defective in some cases, just because they don't want them. But it doesn't matter if it's just hey, I don't want it, versus it's defective. They send them all back, right? And what will happen is that you're going to incur incremental labor. First off, incremental shipping to get it back to your plant, incremental labor to do the plug and play, to see what's wrong or to make any repairs, and then more freight to get it back out for a potential resale. So your margin is going to be pretty much eliminated at that point in time. Your profitability is eliminated. But a sale is a sale. Even if you have a little loss, it's better than having a total loss, right? So little loss are better than big loss. Some profit is better than no profit at all. So as you all get more into your business world, you're going to see a lot more of that. So we talk about purchase returns and allowances, FIFO, LIFO, as far as purchase discounts as well. We'll have one more video shortly, probably next maybe 5-10 minutes, which will talk about trying to pull this stuff together. But the big thing I want you to think about how everything fits together. Our sales price is basically what we're charging a customer for. It's the number of units sold times our sales price. I can have different sales price depending upon who I'm selling to, right? So I may charge Walmart $50. I may charge Target with a slightly different unit, slightly better unit, $55, right? So I charge different customers different things based upon their ability to pay and what kind of features they want. But sales price multiplied by the number of units sold, that's going to come overall give our calculation of sales. Our cost of goods sold, as we talked before, is just our value in the goods. Whether it's FIFO, LIFO, specific identification, whatever it may be, it's just our value in the goods. It's what we have either paid to another vendor that we're buying the stuff from, or if we manufacture it. So sales less cost of goods sold is our gross profit, also called gross margin. It's our best calculation, high-level calculation on profitability. From there, we'll have minus selling expenses, minus G&A, minus all these other normal operational expenses, minus customer service. That will give us our income from operation. From income from operation, then we'll take away tax. And tax is something that most of all of us will never be able to really impact, right? I mean, we do work for some large companies, but for the most part, it's, they have their tax lawyers, tax accountants, stuff like that we probably don't want to be a part of. I personally didn't really enjoy tax, so I stayed away from tax. And that would end up giving our net income or our net loss. Net income means I'm making money, my revenue is greater than my expenses. Net loss means my expenses are greater than my revenue. We always like net income, but we also know there's a lot of companies that have net loss. Well, how do I know that? Because they go out of business, right? We see lots of companies going out of business. On that one, I'll end this one and post it, and I'll give another one for you shortly.